Hello, it's time for another edition of London Direct. Dollar strength has been one of the main stories in the FX markets in recent months, and with the Fed painting a relatively bullish picture of the US economy, will this trend continue? Well, I've been to the offices of Cambridge Mercantile to find out. David, it's really good to speak to you today. Let's start with the US economy. When we consider the statement by the Fed and also that GDP number, we're surely heading towards a rate hike in June, aren't we?
Yes. The base case right now is that we will find the Fed hiking interest rates off of their historical lows in mid to late 2015. Risk to that is that the international economy continues to turn lower, and that causes Fed Chair Janet Yellen to step back from rate hikes, much the way that the Bank of England has in recent months.
I was looking at a 6-month chart of the dollar index without getting too technical. It was just looking like this. Do you think that upward trend for the dollar is going to continue, or do you think that trade is going to get overcrowded?
In the short and medium term, certainly points to further dollar strength, but there are growing tail risks. If those tail risks manifest, then we are certainly looking at a scenario where the dollar pulls back, again, similar to how we saw sterling pull back in the tail part of 2014.
Yeah, so let's concentrate on the pound. It's quite an interesting scenario for the UK. Growth is relatively robust, yet its trading partners aren't doing so well in Europe. So what's your outlook for the sterling?
Outlook for the pound is that it continues to moderate in line with softening interest rate expectations. It really comes down to the economic performance of the UK relative to the other economy it's being compared to. So as far as the US is concerned, risks point to the downside. We could see cable move lower. As far as Europe's concerned, sterling's set to outperform from an economic perspective. As you say, the United Kingdom is experiencing a more robust growth scenario, whereas there's many more risk factors in the Eurozone, namely resurgence of concern in periphery economies.
So what about the Eurozone? We've seen more deflationary figures come out of the bloc, but at the same time, I'd also like to point out that German retail sales really shot up much more than expected. So it's not a one-way street, is it? There are some positives to the cheaper commodity prices.
No, certainly not. You're right. Lower energy prices decrease input costs, making goods cheaper and giving households more real income at the end of the day. What remains to be seen is whether the net impact is a greater impact in terms of disinflation or expansion in output and consumption.
What's your expectations in terms of QE? Do you think it will be successful in fighting these deflationary fears?
QE is a tough one. It's going to be the main concern with quantitative easing is the bottleneck in banks. As experienced in the United States with quantitative easing, banks essentially shored up their balance sheets. There's a risk that such could occur again in the EU, and if that's the case, then the expected increase in output won't materialize, that it'll just be bottlenecked in the banks.
So let's finish by talking about Greece. What's your base scenario for the situation? Do you think that they could possibly leave the euro?
Greece is an interesting situation. Prior to the election, the Syriza party was very hardline about their willingness to negotiate with the EU and Greece's creditors. However, following the election, they very much softened their stance, and their tone has been about getting the EU invested in Greece's recovery and perhaps even tying their schedule of repayments to Greek economic growth as opposed to just a fixed schedule. So it seems like a much more collaborative approach that we're seeing post the election versus the rhetoric that came before the election.
Well, thanks to David for that overview of the majors. Stay tuned to Dukescopy TV for more interviews and analysis, but for now, goodbye.